Welcome to the deep dive. So if you just look at the headlines for Monday, October 27th, 2025, I mean, it looks like pure euphoria.
Absolutely. All three major U.S. stock indices closing at new all-time highs. On the surface, everything's clicking.
But that's the weird thing, isn't it? This huge optimism, these records, they seem to be built on, well, maybe the thinnest foundation we've seen in a while.
It really is the ultimate high wire act. You've got this incredible bullish momentum, we're calling it a trifecta of positive news, balanced against this huge hole where the macroeconomic data should be, thanks to the government shutdown.
And that's exactly what we need to unpack today. We're going to dissect this really historic day in the markets.
Yeah.
We need to figure out the specific things driving the surge, understand, the real problems caused by this 27-day government shutdown, this data void, and maybe most importantly, look at the massive kind of concentrated risk heading into this super week of earnings.
Yeah, and the key takeaway for you, the listener, right up front, is pretty simple but really critical. The old playbook, the macro playbook. It's basically shut. The market's been forced off those broad economic indicators. It has to pivot completely to looking at individual companies, the fundamentals.
So we're running purely on optimism and the hope that companies can somehow power through the lack of big picture data.
Pretty much. Hoping that strong corporate performance just overwhelms the systemic risk that comes from flying blind on the economy.
Okay, let's dig into how this day actually unfolded. The sources make it pretty clear that the big money, institutional capital, was already setting up for a big up day before the market even opened. How did that pre-market action, the futures trading, really set the stage for these records?
Well, the futures market is, it's like an early warning system. It shows where the big players are leaning before the cash session starts. And Sunday night, going into Monday morning, the feeling was, as the source puts it, decidedly bullish. Unmistakably so if you were watching the CME Globex platform.
Okay, give us the numbers, because the specifics really tell the story of what kind of move they were expecting.
Absolutely. So the E-mini S&P 500 futures, that's ESZ25, it was trading up at 6,884.75. That's a jump of almost 0.85%. That wasn't just hedging risk. That was money getting positioned for a serious gap up at the open.
And tech was even stronger.
Oh, yeah. That's what was really telling. The E-mini NASDAQ 100 futures NQW000, it surged even more, up 1.34%, breaking above 25,850.
That difference, right. NASDAQ futures running hotter than the S&P futures. That's a classic signal, isn't it? It suggests investors were actively hunting for risk, wanting that high-growth tech exposure before the market even opened and confirmed anything.
Exactly. It's a clear sign. Capital was chasing risk, betting on those positive weekend catalysts, which, we'll get into in a second. They weren't just hoping for a small lift. They were betting aggressively that this rally had legs, that it would trend higher all day. A powerful directional move was the expectation.
And that bet, it paid off spectacularly.
Yeah.
The whole day saw this surge, pushing everything to new all-time highs by the close.
The momentum held right through. The S&P 500, the GSPC, closed at 6,850. That's a big psychological number, crossing 6,800 for the first time ever, up 1.1% on the day. And the NASDAQ Composite, IXIC, just like the futures predicted, led the charge. Closed up a strong 1.7%.
Even the Dow.
Even the Dow Jones, DJI, finished solidly positive too.
Now, the sources emphasize that this rally was broad. Why does that matter? Why is the breadth not just the headline number, something investors look at to judge how healthy the market is?
Well, when you hit an all-time high, you really want to see that it's not just, say, 5 giant companies dragging the whole index up. A broad rally means lots of different sectors, different size companies are participating, mid-caps, small caps too.
So it shows wider confidence.
Exactly. It signals genuine confidence across the board, maybe in the broader economy, not just a technical squeeze or some index rebalancing quirk. In this case, seeing that breadth confirmed that the strength we saw in the futures wasn't shallow. It translated into widespread buying all day long, and that's crucial context heading into a week with so much earnings risk.
Okay, so where did all this confidence suddenly come from, especially right before a week everyone knew would be volatile? The analysis points to this trifecta. 3 big separate things pushing the market up. Let's start with the first one. Macro political relief. The U.S.-China trade stuff.
Right. This was probably the biggest psychological driver. For years, these U.S.-China trade tensions have been like this constant drag on the market. It creates what we call a risk premium.
Which is basically,
It's like a tax investors mentally apply to stocks because of uncertainty. The worry that, boom, new tariffs could hit, mess up supply chains, crush profits, and just derail everything.
so what specific news over the weekend was powerful enough to make investors suddenly forget years of that risk?
The main thing was this feeling of a significant perceived de-escalation. And it came directly from a comment by the U.S. Treasury Secretary Scott Bessent. He specifically mentioned creating a very successful framework for the leaders to discuss on Thursday.
Hold on a second. A framework, not a deal signed, not even a handshake. Just talk about a framework for future talks. That's really enough to make markets go wild.
It sounds incredibly thin, I know. But yes, the sheer euphoria, the way capital flooded back in, it just shows you how much uncertainty, how much risk from those tariffs was weighing things down. Investors are just desperate to avoid that hit to corporate margins. So any sign, even just talk about a framework from a top official that suggests tariffs are off the table, it acts like a massive green light.
It unlocks capital that was sitting on the sidelines.
Exactly. It lets stock prices rally to levels investors feel are justified if you remove that big trade war risk.
But you also mentioned the sources pointing out how selective this optimism was. Didn't the market have to kind of ignore some other bad news happening at the same time?
Oh, completely. And this is really important for critical thinking here. The market basically put on blinders. While everyone was cheering the potential China thaw, the U.S. actually terminated all trade talks with Canada, and China slapped sanctions on a major South Korean shipping company.
Normally that would cause jitters, right?
You'd think so, but the market just decided, apparently, that fixing the massive China problem was so overwhelmingly positive that these other issues, this other friction, just didn't matter. The focus was incredibly narrow, laser-like, purely on the potential upside from China.
Okay, let's shift to the second part of this trifecta,
Yeah.
monetary policy. The Fed, it wasn't just hoping for a rate cut anymore, was it? It felt like guaranteed money.
That's exactly right. The market had already built in these deeply entrenched expectations for a 25 basis point rate cut at the FOMC meeting coming up on October 29th. It wasn't just a possibility, it was treated as a certainty. Like guaranteed liquidity was on its way, which, helps support these high stock prices.
And what was the one piece of data that really locked that expectation in?
It was that delayed September Consumer Price Index, the CPI report, that finally came out last Friday. Remember, because of the government shutdown and the data blackout, this CPI was literally the only piece of official economic data the market had seen for the whole month. And it came in showing headline inflation at 3.0%, just a hair below the 3.1% consensus. So immediately the narrative became tepid, cooler than expected.
So because the only number available looked a bit soft, the story immediately became, aha, the economy is weakening, the Fed has to cut rates.
Precisely. The narrative drove the market reaction. One slightly soft data point. And suddenly the Fed's complex job gets simplified down to they're forced to cut. And you saw instantly in the bond market, the 10-year Treasury yield dipped down to 3.99%.
Which signals?
It signals that investors believe that liquidity is coming. They're willing to accept lower returns on safe government bonds because they expect the Fed to provide that boost, that tailwind, for riskier assets like stocks.
Okay, that brings us to the third driver, the micro-catalyst that really lit a fire under the tech sector. This AI market expansion idea sparked by that huge jump in Qualcomm.
Yeah, Qualcomm QCOM just exploded, up an incredible 13%. It was pacing the gains in both the S&P 500 and the NASDAQ. The news was that QCOM announced a whole new line of AI chips aimed squarely at data centers.
So challenging NVIDIA and AMD.
Directly challenging the very profitable duopoly that NVIDIA, NVDA, and Advanced Micro Devices, AMD, have enjoyed in that space.
Now, usually when a strong new competitor enters a market like that, you'd expect the existing players, NVDA and AMD, to take a hit. But the sources called this a positive-sum event. How does that work? That seems counterintuitive.
It really does, but this is maybe the strongest sign validating this whole invest in AI at all costs mentality that's gripped the market. QCOM's news didn't hurt the others. NVDA actually rose 2.5%, and AMD was up nearly 1.5% too.
So everyone went up.
Everyone went up. This positive sum reaction, it tells you investors overwhelmingly believe the AI data center market is just a rapidly expanding pie. The message is, The demand for AI power for training large language models, for machine learning, for businesses adopting AI is growing so fast, so exponentially, that there's plenty of room for multiple winners. It's not a zero-sum fight. It's a conviction that this AI growth cycle is massive.
Okay, so that's the trifecta: trade relief, Fed liquidity, AI boom that pushed the market to records. But now we have to confront the huge shadow hanging over everything this week. The government shutdown, this data dark age.
Yeah, the seriousness of this for the markets really can't be overstated. The U.S. federal government shutdown hit day 27. That's about 900,000 federal employees furloughed. For investors, though, the big problem isn't the politics, it's the data blackout. The shutdown has basically stopped the release of nearly all official economic data.
How bad is it? Like, which numbers are we actually missing? Which agencies are closed?
We're missing the absolute basics, the foundational stuff. The Bureau of Labor Statistics, the BLS, closed. So no official updates on jobs, unemployment claims, wage growth, the core things the Fed looks at for its dual mandate. The Bureau of Economic Analysis, the BEA, also closed. So no data on factory orders, the trade balance, and crucially, core PCE, the inflation measure the Fed actually prefers over CPI.
So no jobs picture, no real inflation picture, no growth picture.
Wow.
And that CPI report we talked about was just a fluke.
Exactly. It only came out because it's legally tied to calculating Social Security cost of living adjustments, the CLAs. It wasn't part of a functioning system releasing data. It was an anomaly, which means the market's entire view of the macroeconomy right now is basically built on one accidental, slightly soft inflation number while everything else is completely dark.
Which puts the Federal Reserve, the famously data-dependent Fed, in just an impossible spot, right? They're flying blind into their meeting on Wednesday. How do they even justify making policy without the data they always say they need?
That's the huge dilemma for the FOMC, and it injects a ton of policy risk into the market this week. They are missing the key labor and inflation numbers they need to judge where the economy is actually heading. This data vacuum forces them to look at, well, alternative data. Things like the private ADP jobs report, which, ironically, showed job losses in September.
So the private data contradicts the market's euphoria.
Right. It points the other way, which just highlights the disconnect.
But okay, the market seems convinced the cut is happening anyway. It's priced in. So the actual decision on Wednesday isn't the main event. It's the press conference afterwards.
Absolutely. The 25 basis point cut itself is almost a foregone conclusion now. All the focus, all of it, will shift to Chair Powell's press conference. He has this incredibly difficult task. He has to explain why they're acting without their usual data, probably referencing that alternative data, and then, crucially, he has to signal what comes next. Future cuts. A pause.
And if he sounds hesitant, worried about the lack of data.
If his tone is too cautious, if he hints that maybe they'll wait for government data to restart before doing more, the market, which is banking on continued easy money, could react really badly. It's all about managing expectations in this data fog.
Okay, let's quickly run through the calendar for the rest of the week then. Given this mess, what data points can we actually rely on and which key ones are likely missing?
We basically have to ignore official U.S. government sources for now. What is confirmed and should be reliable is the Consumer Confidence Report on Tuesday that comes from the Conference Board, a private group. Then obviously the FOMC decision and that critical press conference on Wednesday. Looking internationally, we get the European Central Bank's rate decision on Thursday and also the China manufacturing PMI. That China number is actually one of the few really important global data points we can count on this week.
But the big U.S. numbers we normally track are just gone.
Gone. Delayed indefinitely. That includes the first look at Q3 U.S. GDP, the big growth number, the weekly initial jobless claims vital for seeing stress in the labor market right now, and core PCE, the Fed's favorite inflation gauge. The fact that markets are hitting all-time highs while completely missing official reads on growth, jobs, and inflation, it tells you everything about how much faith is being placed on the corporate story right now over the missing macro story.
That leads us right into it. The whole bet shifts the micro to the companies themselves. And this week is the ultimate stress test. Super week for earnings. But we are heading into it with some decent momentum from Q3 so far, right?
Oh yeah, the setup is strong. Coming into this week, about 85% of the S&P 500 companies that had already reported beat their earnings per share, their EPS estimates. And overall, earnings growth is tracking at a hefty 15.1%. That's way better than the 8% growth people expected initially. So yeah, that positive momentum definitely fueled Monday's rally.
But the risk this week isn't just about growth maybe slowing down. It's about how concentrated everything is. You've got 172 S&P companies reporting, but crucially, 5 of the 7 biggest ones. the Magnificent Seven. It feels like the entire market is walking into this narrow, high-stakes gauntlet.
The concentration risk is just off the charts. Think about it. The 10 biggest stocks in the S&P 500 make up something like 38% of the entire index's value. So when 5 of those giants, the absolute engines of market growth, report their results and their outlook all within about 48 hours of each other, the whole index is exposed. It's almost unhedgeable.
Meaning if just one or two stumble.
If just one or two disappoint on earnings or guidance, that whole rally we saw built on that trifecta of optimism could just evaporate instantly.
So, given that enormous pressure, what's the one big question investors need the Magnificent Seven to answer this week? What's the theme?
It really boils down to this. Is all that record AI spending finally showing up as actual profit, or is it still just a massive cost? We've heard for, over a year now about the huge capital spending, billions on GPUs, data centers, AI infrastructure. Now the market needs to see proof. Proof that this unprecedented spending is generating real, measurable revenue growth, especially in their cloud businesses.
And if they can't show that connection,
If they can't clearly link the CapEx to profit growth, it'll suggest these sky-high valuations might not be justified, that there's a massive valuation overhang.
Okay, let's get specific.
Sure.
Wednesday after the bell is the first big test. We get Microsoft, Alphabet, and Meta all at once. Start with Microsoft, MSFT. They're kind of the bellwether for enterprise tech spending, right?
Absolutely. Microsoft is under a microscope because its Azure cloud platform is seen as the best proxy for how quickly big companies are adopting AI, apart from maybe the chip makers themselves. The market expects Azure to grow by a huge 38%. But it's not just the headline number. Analysts will be digging deep looking for hard evidence that Microsoft's big bets on OpenAI, on integrating AI everywhere, are actually boosting the bottom line this quarter. Consensus EPS is $3.65, which is high. And look at the options market. It's pricing in a potential move of around 4.4% for the stock after earnings. That tells you how big a deal this is, how binary the reaction could be for all of tech.
And how does Microsoft's Azure performance relate to, say, Amazon's AWS? Is it just about a growing market, or are they stealing share?
It's definitely competitive within that growing pie. Microsoft has been gunning for AWS's top spot, using AI services and its existing relationships with big businesses as leverage. So if Azure hits or beats that 38% growth target, it basically confirms Microsoft is successfully turning its AI advantage into cloud dollars, which puts enormous pressure back on Amazon when they report later.
Okay, next on Wednesday, Alphabet, GOGL. A bit more diversified, but cloud is still a big piece.
Yeah, for Alphabet, it's kind of a two-part story. First, yes, they need to show continued strong growth from Google Cloud Platform to justify their valuation, especially competing against Microsoft and Amazon in AI. But second, the market also needs to see stability in their core advertising businesses. Search and YouTube. AI might be the future, but ads are still the engine paying the bills today. Consensus EPS is $2.28, so they need to show solid momentum just to meet expectations.
And rounding out that Wednesday triple header, Meta Platforms. Meta. What's the focus there? Advertising.ai, metaverse spending.
Meta is fascinating. The main focus will be on advertising growth on Facebook and Instagram, but also on any tangible signs they're actually making money from their AI investments. Investors are still wary about how much they're spending on Reality Labs, the metaverse stuff. They need reassurance that it isn't completely tanking their core profitability.
So if ad revenue looks weak,
If ad revenue slows, it'll fuel worries that competitors like TikTok are really eating into their business, no matter how much they talk about AI. The bar is high. Consensus EPS is $6.74.
and the gauntlet doesn't end there. Thursday after the close, we get Apple, AAPL, and Amazon, AMZN. Apple first seen as the ultimate check on the global consumer, right?
Totally. Apple's report is less about the AI data center wars and much more about basically how much money people around the world have to spend. Consensus EPS is $1.74. The focus will be on early signs of how the iPhone 17 cycle is starting off, but maybe even more critical will be their guidance. Management has to address how global currency shifts are affecting sales outside the U.S., and also the ongoing costs and hassles from trade tariffs impacting their supply chain.
And then Amazon, AMZN. You mentioned the pressure on them. Their AWS cloud performance on Thursday feels like maybe the single most important number for the enterprise tech story all week.
You could definitely argue that. It's neck and neck with Microsoft's Azure for importance. Amazon really needs this one. They kind of unnerved investors last quarter with softer guidance for Q3. So now the market demands to see AWS growth pick back up significantly. AWS is the cash cow that funds everything else. Amazon does logistics, retail, and crucially, their own massive AI spending. If AWS growth stalls again, it suggests businesses might be cutting back on cloud spending overall, which undermines that whole bullish AI narrative we've been talking about. The pressure is immense.
Okay, stepping back for a second, we can also look at the immediate reactions in after-hours trading on Monday, October 27th. Did those signals reinforce the day's themes?
They absolutely did. It was like an instant confirmation of what drove the rally. If you look at the top 10 gainers after hours, you saw that semiconductor momentum just keep rolling. Names like AMD, Micron, Seagate were all up. It solidified that expanding pie idea from the Qualcomm surge earlier. Investors were basically doubling down, saying, we believe in this sector's growth.
And the losers told the opposite story. Risk on.
Exactly. It was a classic risk-off asset getting hit. The biggest losers list was led by the gold miner Newmont Gold Corp, NAM, down over 3%. That ties directly back to the U.S.-China optimism. When perceived risk falls, money flows out of safe havens like gold and into riskier things like tech stocks. The market was clearly voting for risk.
Now, just to show the kind of detailed analysis investors were doing right at the start of the week, let's touch on 3 other companies reporting right after Monday's close. The specific expectations for them really highlight the different pressures. Let's start with Welltower. Will the healthcare REIT?
Right. Welltower is a great example of valuation risk. As a real estate investment trust, a REIT, you look at funds from operations, FFO, instead of regular EPS. It's a better measure for property companies. Welltower trades at a huge premium. Its price-to-earnings ratio is way up at nearly 35, while the industry average is closer to 13.
It's a price for perfection.
Totally. That high price tag means they absolutely had to hit their FFO consensus target of $1.30. Any miss on that specific number, and the stock could get hammered because there's just no room for error built into the price.
Okay, then you had Cadence Design Systems, CDNS, more of a momentum story, and NXP Semiconductors, NXPI, with a trickier outlook.
Yeah, Cadence Design, they do software for designing chips. The expectation there was pretty straightforward, a beat and raise. They have a strong history of surprising positively, so it was seen as a pure momentum play, betting on the whole semiconductor design trend continuing. NXP Semiconductors, though, NXPI, that was much more complicated. The consensus was actually for their earnings to be down compared to last year. That reflected the slump they'd seen in their main markets, cars and mobile phones. But some internal models were predicting they might slightly beat those lowered expectations. So the real story wasn't the number itself.
It was the commentary, the outlook.
Exactly. Investors were listening intently for any confirmation from management that the worst was over, that the cycle was turning back up for them. They needed validation for the optimism the market was showing for the whole chip sector, despite NXPI's recent struggles.
All right, we've covered a huge amount of ground here. Let's try to pull it all together. This record-setting day, October 27th, it was driven by what you called unambiguous bullishness, fueled by that trifecta. Relief on trade, guaranteed money from the Fed, and this powerful AI momentum.
But, and it's a huge but, all that excitement, all that positive energy, it's really just masking a massive underlying risk. The market is completely priced for good outcomes. There's zero margin for error baked in right now.
Wow.
And it's happening while everyone is operating inside this government-induced macro data blackout.
The whole week is basically a high-stakes bet.
It's a structural bet. A bet that company performance, the micro-level stuff, can somehow just overpower the systemic risk coming from the missing macro picture.
Okay, so this high-wire act, this bet, it's going to be decided by a few key moments this week. Let's just quickly recap those critical inflection points for listeners to watch.
Right, 3 crucial moments. First, Wednesday after close, that's the big one. MSFT, GeoGL, Meta, the ultimate test of that AI revenue story. Does the spending translate to profit? That result could dictate the fate of this whole tech rally.
Second key moment.
Wednesday afternoon, the FOMC press conference. Forget the rate cut itself. Listen to Powell's tone. How does he justify acting without data? What does he signal about future cuts? Any hint of caution could drain liquidity hopes fast.
And the third.
Thursday after close, Apple and Amazon. This is the final reality check. Apple tells us about the consumer. Amazon's AWS tells us about enterprise spending. If either of those looks weak, the market's underlying economic assumptions get questioned hard.
Wow. So this really has been a deep dive into what feels like a tale of two drivers. On one side, you have this intense, concentrated focus on big tech earnings. On the other, this huge systemic risk from the data blackout.
And, this whole situation, it forces us to ask a really fundamental, maybe even provocative question. It defines the bet investors are making this week, and maybe it hints at a bigger shift. Think about it. Investors are essentially betting that strong results from a few huge companies make the government's official economic stats irrelevant. That it doesn't matter what the BLS or BEA would have reported as long as the Magnificent Seven deliver.
So are we moving into a world where the performance of just a handful of tech giants becomes the economy, where their earnings actually dictate economic perception, maybe even force the Fed's hand more than the traditional government data ever did?
That's the pivot. That's the potential shift in the hierarchy of information we're seeing play out right now. Is corporate data becoming more important than sovereign data? That's the core bet this week.
A fascinating question to end on. Thank you for joining us for this deep dive.
Thank you. Keep a close eye on those 3 inflection points. The market's conviction is about to face some serious tests over the next couple of days.